Welcome everybody to the April Opus Faveo webinar entitled The Black Arts, Valuation for Early Stage Spinouts. My name is John Dupree and I'm an Opus Faveo partner, and I'm joined by my partners Christian Blackwell and David Overton. We're very glad you're here with us today. Valuations for early stage spinouts is interesting and a fascinating topic. We're going to spend only 30 minutes on it today. We could spend a lot more because it's just a fascinating mix of science and art, and it's so very important to faculty members, to technology transfer officers, to researchers, all those people in universities, also to angel networks, alumni mentoring groups. All those who are interested and active in university spinouts need to understand valuation and what it means to you. A, because it helps researchers and entrepreneurs build value, which when the university has equity shares, builds value for the university. It assists your angel and alumni funds. It helps you make good licensing decisions. And it simply allows you to know what the portfolios are potentially worth that you own as a university. But it isn't always easy, nor is it always straightforward. So hopefully what we'll do today is in 30 minutes or so tell you a little bit about this fascinating topic. So let me start right off and ask you, Christian, so what exactly is valuation?
Thanks, John, and hello, everyone. Valuation is often viewed as this kind of black box that you get some finance people together, they do some modeling, spreadsheets, whatever other scientific process, and that black box ultimately determines a perfect answer, and you're done. The reality is much more nuanced and complex. Valuation, first off, is based off of a cascade of assumptions. So the process of, let's say, creating a financial model, for example, is important because you were thinking about the assumptions. And each step we think is key to understanding how a business is going to work. However, when you get to the end of trying to come up with a valuation, you end up with this cascade of assumption upon assumption, which creates difficulty in coming up with that perfect answer. The other issue is really highlighted by looking at what happens in very efficient markets with lots of information. So let's take the U.S. public markets for equity as an example. In the case of the U.S. public markets, you've got fairly perfect information. You have the U.S. Securities and Exchange Commission, which is ensuring that companies are reporting fairly and accurately. These companies are reporting under U.S. generally accepted accounting principles. Their financial statements are audited. You have star analysts from big investment firms who are analyzing these companies. And you have a pretty consistent stream of pricing information, which gives you some level of valuation. And yet, if you watch the stock market, you'll notice that stock prices tend to vary quite a bit, even in the course of a day and certainly over the course of a month or two. And in the case of an acquisition of a public company, you will again see big discrepancies between the public market price and a bid price in an acquisition, in a tender offer, for example. So in public markets, where you've got all these wonderful things, you've got a history, you've got great information, lots of people studying it, moment-to-moment price, what you see is a difficulty in establishing a true value. Well, in a small, early stage, private company startup situation, it is even harder. Outcome distribution. Now, this is kind of an interesting point. When you think about the way an outcome of an investment in a startup works compared to how it works in one of those public companies, you again see a big difference. In the public company example, you're investing, and let's say you want to get your money back in 5 years, and the potential outcomes that might arise end up being, if you were to plot them, end up being kind of a more or less a bell curve, with most of the potential outcomes being clustered in the middle as kind of a little bit of a gain, a little bit of a loss, or kind of neutral. In the case of a startup, the outcome distribution tends to be much more of a barbell. It's binary. And unfortunately, it tends to be skewed towards the negative. But what you see is a lot of complete losses, and then you see the complete wins. And there are less of the outcomes ending up in the middle. With all of this, however, you still end up with the core issue that valuation is unavoidable. You're going to have to set a price at some point if you're raising money for an early stage company. You can kick the can down the road a little bit with convertible debt, which is kind of like a punt. However, you do have to ultimately set a valuation, and that's where you end up with a little bit of science, a little bit of art, and it all comes together in what can sometimes seem like black magic.
So, Christian, so there are some I'm assuming, consistent methods which people use to do valuation. So what are they?
Well, so at Opus Faveo, we've got 5 methods that we use. These are methods that others use, maybe not all together, maybe they don't use all of them, but this is what we use, and this is kind of the methodology that we take. We'll talk about each one of these in turn. We'll spend most of our time really on A and B, discounted cash flow and return targeting. But do keep in mind that when we do this, we'll do it using all 5 methodologies and blend them to triangulate on an actual value.
Well, let's start with discounted cash flow, because that one I think at least I've heard of. A lot of people have heard of it, and it's one that appears in the news a lot. So David, maybe you can tell us a little bit of what kind of discounted cash flow actually is.
Sure, John. Thanks. Yeah, discounted cash flow is a core valuation method. It's one that's very commonly used in corporate decision making, but it also definitely applies to startups. The basic idea is to project or estimate the future cash flows, and that includes inflows such as sales and outflows such as expenses and capital expenditures. And then the net cash flows for each time period are then discounted at an appropriate discount rate to get the current value, or often referred to as the net present value. So the basic math on this is pretty straightforward. The real challenge here is in the assumptions, and those include what the projected cash flows are, which is subject to a lot of uncertainty, and also the terminal value, which is the value at the end of the time period that you've done the projections for. And that's a really big factor. And then the appropriate discount rate, which needs to reflect the time value of money and the risk involved. This next page relates to that first assumption, which is the cash flows. Established corporations, as Christian suggested, usually have the advantage that they have some history on which to base their projections of cash inflows and outflows. This could be because the analysis relates to an existing company that they're buying or selling, or it could be that the investment is similar to other projects that they've done in the past. That historical data then serves as a basis for estimating the cash flows and for assessing the level of risk. For a startup, however, that history is generally not available. And as this diagram shows, the startup is in the very difficult position of having only projections. So there are projections about what's going to happen in the near term, and then typically the terminal value at the end of that projection period is also based on more projections. And so that is one reason that the discount rate in startups is much higher, because the level of risk is so much higher.
Oh, thanks, David. So you've got a terminal value, some expected financial future state, and then you're basically taking this risk, and the discount rate is a way of sort of quantifying this risk. So, Christian, maybe you can tell me a little more about what goes into a discount rate. How do you do that?
Yeah. Well, so in my view, and I've been inside Fortune 10, Fortune 100 companies, and I've had them as clients, dealing with the people who do this. And I'll tell you, John, I think the biggest secret in the corporate world is the discount rate. And the non-finance people in the room will laugh at that, and the finance people will knowingly laugh at that. So the discount rate is critical in corporate decision making, and in large companies, what you'll see is a group of people. They tend to be kind of the rocket scientists in the corporate finance group or in the treasury group who will be tasked with deciding the discount rate. You might have other individuals contributing components to the discount rate, risk hurdles around country risk, for example, but it's taken very, very seriously. A lot of analysis goes into this. When you think of what is a corporate discount rate with all this analysis, there's going to be a fair bit of variance because it's going to depend on the credit rating of the underlying company. Obviously, you've got companies that are highly rated with a AAA rating. You've got so-called junk companies or high-yield companies. The discount rate will depend on the underlying project, the country it's in, etc. But just to give us an idea, kind of a ballpark of what sort of discount rate we might be talking about in the corporate world for a U.S. company or a Western European company, think somewhere in that kind of 10% range. Put that number in your mind. In the venture world, in the early stage world, where investors are taking a lot of risk, there are a lot of unknowns, the typical number you're looking at is 40% or even greater. So a big discrepancy when you're looking at established companies versus startups. But the key takeaway here, besides the fact that it is a bit of a secret.
Besides the fact that I really don't have to learn this formula.
Exactly. Although, you know,
I just have to say, 40%.
Although if you're doing it, it certainly helps, and at Opus Faveo, we play with this formula quite a bit. But ultimately, even in those large corporate settings, it's still a judgment call.
Yeah.
And we laugh about it here, you know, how about 40%? But you see that even in the corporate world. Typically, what I've seen in corporate decision-making in the boardroom is when you're trying to assert a value for an acquisition, is you'll end up seeing a matrix with different discount rates showing what the value will be depending on what the discount rate is.
So the discount rate is just you're imputing a financial risk to this projected future state. And then that goes into the price that you may or may not be willing to pay. But so tell me a little bit about what this projected future state is that you've chosen.
Yeah. So again, what you're doing here with the discount rate is you're discounting the cash flows that you expect to be coming out of this business back to the present day, time value of money. The problem is that when you do the financial forecast, you're going to have an end date. You're going to have a horizon. In the startup world, it's pretty common to do 5 years. Some corporate stuff, you'll get into 10, 15-year projections, but you still end up with that last date of your projections, that kind of event horizon. And the question is, well, what happens at that point in time? And in general, you expect that the business will continue to generate cash flow after that event horizon, after that end of the financial projection. And you need to account for that in the valuation. Well, how do you do that? And the ironic thing here is, and we talked about the discount rate being the corporate secret. Well, this is sort of the dark secret of discounted cash flow analysis. Very often, most of the value is in that terminal value number. So you've done all this modeling, you do this fancy discounting, and you're still stuck with the problem that you have most of the value in the company is this end number that you have to figure out how to calculate. And you know, we put Henry David Thoreau's grave here, both because it highlights all of the work that goes into trying to come up with a value, and also the fact that you still have to kind of transcend all of this and come up with a number here for the terminal value. So how do you do that? Well, you can do it with a perpetuity calculation where you assume a future steady growth rate starting at that endpoint of your financial projection, or more often, especially in the corporate world, what you're doing is looking at comparables, and we'll talk more about that here in a minute.
So you're making a bunch of assumptions about whatever the terminal value may be. You're making a bunch of assumptions about the risk to get there, and that kind of gives you a ballpark with which to negotiate the price. Now, David, I understand discounted cash flow a little bit better, but when I talk to venture capital firms or entrepreneurs, they're often talking about multiples, not discounted cash flow. Can you tell me kind of what that means and how a multiple relates to a discount rate?
Sure, John. That second method that we talked about, or return targeting, That is an important valuation method, and it is, as you said, one that's frequently used by VCs and other early-stage investors. The basic idea is that I want a certain return over a given time frame, such as a 5x return over 5 years. If I have an estimate of the future terminal value, I can determine the current valuation simply dividing by that multiple. So to take a simple example, if I believe the company will be worth $10 million in 5 years, and my return target is a 5x multiple, I will value the company at $2 million today. And I'd be willing to pay, for example, $200,000 for a 10% equity stake. This approach makes sense to VCs because they're generally investing over a finite horizon. It's a simple method, but it's important to note that the discount rate and the concept of discounted cash flow is really at the core of it, because you're basically, there's an implicit discount rate embedded in that multiple. For example, a 5x multiple over 5 years implies a discount rate of around 40%, and a 10x multiple over 5 years is about a 60% discount rate. That return target can also change over the life of a startup company. It's typically highest when the company is brand new, when the risk is the highest. And so because the risk is higher, the effective discount rate is higher, and that's implicit, that's embedded in that higher multiple. And that, as the company develops, through raising money and through developing its product, perhaps through generating revenues and gaining customers, the level of risk declines, and that is reflected in a lower multiple over time.
Okay, so really the multiple is in some ways, you might say it's VC speak for the same function as the discount rate. It's a way of finding a risk inherent to getting to that end state, that exit state, whatever that is. Yeah. So Christian, we talked a little bit about discounted cash flow and a little bit about return targeting. What other ways might someone value a company?
So we mentioned at the beginning at Opus Faveo we've got 5 methodologies, and I'll touch on the last 3. The one that you'll see relatively commonly is comparables, and we talked about that a little bit in the terminal value discussion as well. And the idea here, and it's easiest again to go back to large public companies, the idea here is let's say if you're looking to acquire a car company, and you're trying to assert a valuation on that car company, what you can do is look at other car companies and say, how are they valued? So let's say you're looking to assert a value for Ford, you would look at GM and Toyota and so on, and look at their value, and you would tie that to a ratio of earnings, in the case of a PE ratio or price earnings ratio, or more commonly EBITDA, or earnings before interest, taxes, depreciation, and amortization, which is considered to be a truer form of earnings, or even revenue. And so you just determine the value of, let's say, Toyota and all the others, you'd average them as a ratio, and you would look at the earnings, revenue, EBITDA for Ford, and voila, you come up with a valuation. The other way you do it is you look at comparable transactions, so other acquisitions that have been done of similar kinds of companies. In the startup world now, you don't have it as easy because we've already talked about this, you just don't have the information. Where you do tend to have the most information is around comparable transactions. So if you've got a computer science, let's say it's a cyber startup, cyber technology startup, you can look at other cyber companies. In this case, you can look at some public companies that are out there, look at them usually as a ratio to revenues, their valuation. You could try that. But you're a startup, so what you'll do is you'll look for information on similar transactions for cyber spin-outs coming out of a university. The problem here is that these are private markets. They tend to be fairly opaque, so it's difficult to get that kind of information. There are databases that you can pay for, you can subscribe to. They tend not to be cheap, and they're relying on people's willingness to report these private transactions fairly and accurately, which often they don't want to do. So a little bit difficult. The last 2 are methodologies that we've developed at Opus Faveo, grappling with this problem of how better to assert a value. Book value is not, for the accountants listening to this, It is not accounting GAAP book value. What we're talking about here is sort of a proxy for accounting book value that we developed by looking at all the investments that have gone into creating the company that we're valuing, this startup. So we'll look at research dollars that have been put into this. We'll look at sweat equity. We'll look at, from a U.S. standpoint, SBIRs. Other countries have similar non-dilutive government grant programs. So we'll look at all the research dollars, the sweat equity, add it all up together, and you end up with this kind of book value number. And finally, taking a page from Royal Dutch Shell, which developed the earliest scenario planning kind of analysis, what we do is we develop different scenarios. At its simplest, you develop a conservative, a base case, and then an optimistic case. We assign probabilities to those and determine kind of a weighted valuation, but you can get also a lot more nuanced around certain kinds of events happening, et cetera, in determining those different scenarios.
So David, if you take all these methods, do they all give you the same solution? Is it fairly clear what the valuation is when you apply these?
Well, John, it's usually not that simple. But here's an example to illustrate how all of this may come together. And this is really a disguised example, but it's similar to what we've experienced with some of our recent clients. These numbers all reflect valuations for the same company based on the different valuation methods. And as you can see, there's a range of answers reflecting the different assumptions and the different methodologies of the various methods. But from this, a pattern starts to emerge, and here the valuation appears to be falling in a range of $2 to $4 million. Of course, if you're the founder, you'd like to focus on the higher valuations, and if you're an investor, you would push for the lower numbers. But using multiple methods helps to create an understanding from which an investment can occur that both parties feel is fair.
Yeah. So even in this, for a startup, $2 to $4 million is a fairly substantial range of potential value. So Christian, who decides?
Well, John, from my standpoint, this is the single most important takeaway from the entire the entire discussion today. Ultimately, both parties decide. Valuation is a purchase price. So think back to a Middle Eastern bazaar or a Latin American market where you're negotiating over the price of a piece of fruit or a rug or piece of clothing. It is the valuation, the price is what someone will pay for it and what someone will sell it for. It is negotiated. So often people want to think that this is much more objective, and the reality is it's quite subjective. The valuation becomes easier once you have more information. As companies mature, as you set valuation points in time, as there's more history, it becomes easier. You can more readily establish that valuation. The other point here to make is that when you can develop demand, like in any market, when you can develop a lot of demand for what you're selling, in this case equity in the company, you're going to have an easier price bumping up that price, easier time bumping up that price, that valuation.
So in the case today, we have faculty members, researchers, OTC members who are oftentimes very, very expert in royalty negotiation. But what would you tell them about equity valuation?
Well, here's the interesting thing. First off, from the university standpoint, we believe that a higher valuation generally is going to be better for the tech transfer office and for the university on the whole. We're big believers in universities using and developing PR around their spin-out activities. We think that's one of the big advantages that spin-outs confer to the university. And the higher the valuation you end up with in a funding round, the better PR you're going to get. Now, obviously, this is all within reason, John, because you don't want to get so high a valuation that the investors end up losing their shirts, but the investors tend to be big boys and girls who can look out for themselves. So it's in the interest of the university to work with the founders of the company to try to help that process along. one of the interesting things we've learned is that while investors are interested in things like license fees and how much equity or royalty does the university want in exchange for a license, and tech transfer offices tend to be pretty focused on that, the investors often are looking for other stuff, and those other kind of intangibles can be far more important in developing those relationships with investors. It's no secret that a lot of investors don't particularly like dealing with universities. We think this is a problem, and we think the problem can be pretty readily addressed by working on these intangibles, being a little more open and transparent to discussions with investors, and getting into the weeds with some of these license terms that are not necessarily economic. And ultimately, we think this can generate far more upside for the university than trying to keep the investors a little more at arm's length.
So just to summarize, the valuation is, in its ultimate definition, simply the price, for which the buyers and sellers are willing to transact a sale of shares or equity in the enterprise. And these methodologies are ways for you to fairly place a value on that equity, but it's ultimately a negotiation. I think the very interesting thing for the universities is that this can be hugely impactful for you, because in most cases when you're dealing with spin-outs, you're retaining some degree of equity, and that equity can grow in a much more compounded rate even than the royalties if the company's successful. So it's in your interest, as it is with the founders, to create opportunities for that company to achieve a higher terminal value. And that means making it easier for investors to invest, strategic partners to partner, and customers to buy from them. So don't avoid looking at that as part of your due diligence as an OTC. And then helping your researchers and your PIs reduce risk factors along the way is important, because as that risk is reduced, it becomes a different calculation for people who are buying equity. They become more and more comfortable that you will reach that terminal value. And it can be not only impactful to your PIs and your entrepreneurs that are running your spinouts, but it's going to be impactful as you're working with university mentors or with universities. So many universities now are starting alumni angel networks, and they'll be intensely interested in valuation. So by becoming an expert in valuation, or at least conversant in valuation, you can be a real asset to multiple parts of the university that are going to be looking at this. And we hope we helped you do that a little bit today. This is a complex topic, so we'd ask you to get in touch with us if you'd like to learn more. We actually do a 2-hour on-site valuation forum that we can do at your institution, and we go through the various valuation techniques and do some modeling and some examples to allow you to understand it better. And oftentimes those are popular with tech transfer officers or people who are in or leading alumni angel networks, maybe your university accelerator incubator, and then your entrepreneurs themselves or your PIs. And just contact us at info@opusfaveo.com, and we'll be happy to talk to you about them. And of course, we're always happy to talk to any university researchers or TTCs or OTCs or PIs that have an opportunity. We love starting new spin-outs and helping get new spin-outs up and running. So by all means, contact us at Opus Faveo. We'll be very happy to help you. David, thank you very much. Christian, thank you. This will be on our website, the recordings, and if you'd like additional information or a copy of the PDF file, send us a note at info@opusfaveo.com, and we'll be happy to help you. And we look forward to seeing you at our next webinar. Thanks very much.